Equity markets are at a very interesting phase. While markets have done exceedingly well in the last 12 months, we have to see the markets in the context of what they have delivered in the last 5, 7 years. India, in our opinion, is coming out of a structurally weak earning environment and entering a very strong phase of growth for a large number of businesses. Most of this can be seen from the fact that unlike earlier, where only two or three sectors used to account for all the profit shift, today we are seeing profitability improving across sectors. So, for example, what happened to pharmaceuticals in terms of improvement of profits also happened to information technology companies, then followed on with metal businesses starting to show very sharp improvement in profitability, where profits, in fact, have been multiples of what they were actually in the last 4, 5 years. So this significant shift in profitability across bodes well for Indian equities from a medium-term point of view. Very interestingly, the earning growth trajectory in India, the overall earnings as a percentage of GDP in India, which had collapsed to a very low number in the last 5 years, have started to revive. And I think they will directionally be on a much stronger wicket in the next few years, given the underlying earning shifts which we are seeing. All this means that for investing in equities, there are significant multiple opportunities which are coming through, and the markets are actually reflecting it by becoming much more broad-based, and you've seen no participation happening across sectors. A broader market with the earnings coming from a larger cross-section of companies makes or provides us a view that it is far more sustainable than a narrow market where earnings were pulled up by only a couple of sectors. The recovery of global growth, which was very, very muted in the last several years, has also been a very important contributor to the significant uptick in profitability of Indian businesses. If you look at it, a meaningful part of earnings of large companies in India is derived from what happens to global prices of commodities, what happens to global demand, especially say in IT services, pharmaceuticals and engineering exports. So when you see it in context, a very strong global recovery bodes well for increased capacity utilization in India, better pricing for its manufactured goods, and overall much better profitability. After years of a drought in terms of scale up of manufacturing in India, we are seeing, for a multiple of reasons, the whole economic activity towards setting up manufacturing capacities coming together and possibly creating a platform for many, many years of growth. If you look at what happened in India in the last 7, 8 years, has been very little incremental investment or capex, primarily because India was utilizing the capacities created in the 2007 to 2010 cycle. In the last several years now, capacity utilization for several categories has started to improve, and now the need for capacity is becoming urgent. The basic shift of global buyers wanting to source more from India as against China, I think, is becoming a very important structural theme for manufacturing, because global suppliers want to diversify away from just one large source, given the challenges of what has been seen and witnessed in the last few years. Also, importantly, the real equation in India in terms of port infrastructure, in terms of policy support, like, for example, you just need to pay 15% manufacturing tax or income tax for new capacities set up before FY23. And the overall tax rate in India has also been reduced by the reforms which have been carried out. And all this supports investment and capacity creation, which I think will be a most important driver for overall economic growth in the next few years. A manufacturing-led recovery for the economy bodes well for significant investment, which generally bodes well for overall growth and overall broad-based growth in the economy. So all in all, you might see the recent rally as a very, very sharp rally and valuations becoming expensive. But I think from a medium-term point of view, where the earnings base in India is today, and the outlook for growth, which is coming both from domestic as well as international global growth in the economy, I think all of this together should support a strong earning momentum environment for large businesses, which actually is a very positive for the broader equity markets. The low base of earnings in the last 5 years creates a fantastic platform for recovery in earnings and growth, supporting equity investing for the next 1 to 3 years in India. Nippon India Multicap is a strategy which is completing nearly 16 years and has worked and delivered through cycles. Nippon India Multicap focuses on investing across market caps, large cap, mid cap, and small cap, and at all points of time has at least 25% invested in each of these segments of the market. The focus of Nippon India Multicap has always been towards identifying opportunities ahead of the market, scalable growth opportunities at reasonable prices, and participating in them for the medium term. What is important in this category is that when you choose, you actually get opportunities, significant opportunities in mid and small cap spaces, which slowly over a period of time become large and create a lot of investor value. So the focus of the fund is to identify a lot of businesses reasonably young and have a potential with capability of management, with business models which are relevant for the current environment, and the ability to grow market indices over a period of time. And all this leads to capturing greater value for the shareholders in the fund. The Nippon India Multicap Fund also focuses on specific areas where thematically there are material, meaningful opportunities from a 1 to 3 year kind of a time horizon or longer. Specifically, manufacturing or engineering, which is a very significant investment theme today and an opportunity for the fund, because as India comes out of its capex drought into a capex flood in the next few years with significant investment and growth, you would find that many segments of the market which have been ignored can create tremendous value. Over the last few months, you would have heard about a large number of announcements in terms of new capacity creation in sectors like steel, in chemicals, in pharmaceuticals, food processing, and the government supported PLI incentives leading to increased manufacturing capacity creation in India. When you put this in the context of the lower income tax rates as well, manufacturing today is becoming extremely attractive. And we are seeing now a large number of companies investing for capacity creation and growth. To capitalize on this opportunity, the fund is overweight on engineering investments and industrial investments, which benefit from the change in economic and capex cycle in India. Other segments where the fund is focused on are businesses where there is a sustainable competitive advantage, like in the case of large corporate banks, which clearly are gaining market share from rest of the market, like the non-banking finance companies, or telecom sector leaders who are gaining market share from the other players in the market, where we can see profit improvements which are actually ahead of average profit improvements in the economy. The overall growth profile of the fund is towards companies which will grow faster than average economic growth in India, and hence use capital efficiently and hence produce significant economic and shareholder value over a period of time. The fund also has disproportionately higher exposure to the opening up trade, because we have seen significant pent-up demand in many subsegments of the market, which will benefit the fund's holdings. The focus of the fund has been in areas where opening up allows for meaningful earning growth for companies. And these COVID damaged sectors can be very important source of value creation in the next 3-4 years. So investments in retail sector, hospitality sector are all reflections of recovery trade. And as economic activity starts normalizing post-COVID, some of these sectors could be very important sources of alpha in the medium term. Another important focus for the fund is choosing carefully and investing in select technology businesses, which are businesses of the future and where business models are getting stabilized and established, and where the opportunity for disproportionate growth way higher or way above the normal market averages exists. Interestingly, what has happened in international markets is starting to happen in India, where we are seeing tech disruptors and several such businesses coming into play, which actually can create markets of their own in the next several years. The fund is focused on these areas as well to capture value from a medium-term point of view for its investors. Given that the Nippon India Multicap straddles across large, mid, and small cap categories, as a single portfolio, it would represent capturing the whole India opportunity in a single product. The focus on an average is to see how you can invest in companies with growth profiles which are better than the market, across each of these categories and where the valuations are really beneficial from a point of view of the growth outlook for these businesses. The fund has material overweights in specific themes versus the index, and hence the portfolio is differentiated versus what the index actually offers, which creates an opportunity for investors to benefit from what can happen in the market in the next 3-4 years rather than what has worked out well in the last 3-4 years, which generally an index captures. Given the attractive long-term opportunity in investing in equities in India, investors can consider the fund as a part of their asset allocation strategy and their long-term wealth creation journey in India.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.